We continue with the fourth video with an example for income tax. In this question, L Limited has a year end of December. When preparing its financial statement for the year ended 31st December X5, L Limited estimated that its income tax payable would be $62,000. L Limited settled this tax liability on 30 September 20X6, which is the following year, paying $65,000. The tax estimate for the tax year ended 31st December X6 is $43,000. We are required to record the tax entries for the year ended 31st December X5 and X6 in the ledger accounts, and to prepare the loan note which relates to the income statement for the year ended 31st December X6. So we open our income tax expense account. We've got the current tax payable of $62,000. Again, tax is an expense, so it's going to have a debit balance. So $62,000. Then in the income statement, we paid $62,000 has been paid in 20X6. So the income tax, the income statement will be debited. We have at the end of this December X5, we've got a liability of $62,000, which has not yet been paid. So the income statement will be debited with $62,000. Then the statement of financial position will create a liability of $62,000. But remember, the income statement is closed. The income statement does not have an opening or closing balance. So at the end of the year, the income tax expense account is closed by taking the $62,000 to the income statement as an expense. So debit income statements with the $62,000 to close off 20X5. But in the statement of financial position, you've got an income tax expense of $62,000. Then in the following year, we make a payment. The payable, we reduce it by the payment, so we pay $65,000. Remember, this account it closed there, opened this side as a liability, the credit balance, the 62. Then we paid 65, so we paid more than the expense. We're now in 20x6. In 20x6, Elco settle this tax liability. Okay, 65. The tax liability in 20x6 is how much? Is 43,000. So remember, income tax has to be paid after the financial statements have been closed. So in 20x6, we have 43,000 liability, which will be carried forward to, so debit the income tax expense 43, credit the payable 43 at the end of the year, which will close, and this will be paid. So this 43 is carried forward in 20x7 as the opening balance, and it will be paid for in 20x7. At the end of 20x6, it's just closed up, and the liability created in the statement of financial position. So you have to put a note. So tax note for the tax year 20x6. The tax charge for that year is 43, which has not yet been paid, to be paid in 20x7. Then there's an under provision in respect of prior period of 3,000 to give us 46,000. It's an under provision because the estimate which was made was 63,000, but when the actual tax was computed was 65,000. So there was an under provision in the prior year of 3,000. Let's now make a comparison between a sole trader and a limited liability company. We'll start with ownership. The sole trader is the proprietor and he owns their business, but the ownership in a limited company is often a large number of owners who are called shareholders. They just buy a percentage or a number of shares in that company. The second difference is to do with liability. A sole trader has unlimited legal liability regarding their business, meaning that if the business defaults, even their personal assets could be grabbed by the creditors. With a limited company, the members or the shareholders have limited liability, which means that they are only liable to the extent of their investment in the business. The creditors will not come after their assets should the business fail. The legal status of a sole trader is that the business and the sole trader share legal identity. Although the business is a separate business entity for reporting purposes, just for reporting purposes, but there's no distinction, meaning the sole trader will still be held accountable for the dealings of the business. For a limited company, the company is treated as a separate legal entity. So if the company fails, you cannot sue the owner of the limited company. The next comparison is the management. The sole trader usually owns and manages the business on their own, whereas the limited company, the shareholders do not usually manage the business, but they do appoint a board of directors to run the company on their behalf. The profits for a sole trader they belong to the sole trader. So each time the sole trader takes out either money or goods from the business, these are known as drawings out of the business. Any cash taken out is not a business expense, but instead it's a reduction of the sole trader's profits initially, eventually reduction of capital. For a limited company, the shareholders receive profits in the form of dividends, which are paid out after all expenses in the business have been settled. The remainder of the profits which are not paid out are retained in the business as retained earnings. Then the directors, who are employees or who have been assigned by the shareholders to run the companies, these are paid a salary which is an expense to the business. The next comparison is taxation. The business profits are taxed in the hands of the proprietor. So when the partnership, when the sole trader has made the profits, they are the ones who pay the tax. Whereas for a limited company, the income tax is paid by the company from the company profits, not by the individual shareholders. The next comparison is that the statement of financial position for the sole trader, the middle of the statement of financial position is split into opening capital, profits, and drawings, whereas the middle of the statement of financial position for a limited company is split into share capital and reserves. Legal requirements, we've discussed this before. There are no legal requirements specific to a sole trader, but the limited company, there are extensive legal requirements governing the limited liability companies. They have to follow certain reporting guidelines which may not necessarily apply to a sole trader. And lastly, the sole trader business is closed to outside investors. If you're a sole trader, you are not allowed by law to go on the stock exchange and raise funds. You can only raise funds from your friends, your close friends, or your relatives, but you cannot raise funds from the public. Whereas for a limited company, investors from outside the company, even investors whom you do not know, if they so wish, they may invest in the company. So that brings us to the conclusion of Introduction to Company Accounts. We will follow this up now with questions in the next section. Thank you for your attention.